Okay, welcome to our webinar. The topic is the federal budget and life insurance strategies. As a reminder, the content here is simplified for clarity. We can provide a lot more detail afterwards. Here we want to give you an overview. And on your screen, if you're at your desktop, you'll see that there is a box where you can type information. So you can type in things here, questions, comments, etc. And then you click on this send arrow here, and then the message will appear here. If you're using a different device, such as a tablet or your smartphone, then the screen would be set up differently, but you'd have the very same capabilities. The mortality curve is really the key to the tax advantages that life insurance provides. If you look at this, you can see that if you pay for your insurance for 1 year at a time, the cost will get more and more expensive. So if you have $1 million of insurance, you get to the point where you're spending $200,000 for a year of coverage, and then $400,000, $800,000. Basically, insurance becomes less and less affordable, and that doesn't make a lot of sense. The only way to deal with this is with another compound growth curve, and that is compound interest. What you do is you put in extra money in the early years when the insurance charges are low, and then that grows to provide enough to cover the charges later on. Insurance, as a result, has a number of unique tax advantages. First of all, the death benefit is tax-free. This is very much like your principal residence. And you have an envelope for the tax-sheltered growth because that's the only way to cover the charges in later years. This is something like your RRSP. Now, you may find that when you reach retirement, you no longer need the insurance. You could take withdrawals, and as with your RRSP, there would be tax. And with an RRSP, you're forced to take withdrawals. With life insurance, you are not. But with life insurance, you can do something else, which would be even better. What you can do is you can access tax-free income. And the way this works is you use the equity inside your insurance policy as collateral for loans. Now you have something which has the effect of a tax-free savings account. And finally, if you want, you can use the equity inside your policy as collateral for investment loans. And now you're able to get tax deductions. You have something which is like a home equity line of credit. So life insurance is able to combine these unique advantages, but there are limitations. There are 3 key rules that limit the tax benefits. First of all, there's a limit on how much money can go inside the policy. That's called the maximum tax actuarial reserve, which governs that. Then there's also a limit on investment growth called the 8% rule. The idea is to have relatively stable returns inside insurance rather than fluctuating returns that go up really high and then really low. And finally, there's a restriction on the timing of deposits. The 250% rule essentially says that you want to make deposits to your life insurance in the first 7 years. So those are the rules that apply. And life insurance products are tax optimized. So when I was developing products, we would always look at competitiveness, of course, but we would also make sure that the products worked in the tax regime. And this wasn't that difficult because we had the same tax rules for life insurance from 1982 until the end of 2016. So that was very good. In that sense, we were able to focus on improving competitiveness and features without having to worry so much about the tax implications. But on New Year's Day of 2017, a new set of rules came into effect, and these were not quite as good as what we had before. There was less deposit room, or there is less deposit room now, and there is a smaller capital dividend account credit, which is something that matters for life insurance policies that are owned corporately. And finally, there are smaller tax deductions on premiums. But that's what happens, so what can you do? To help people understand these things, we created various content, including a range of YouTube videos. The good news is that the old rules continue to apply to policies issued before the new rules came into effect. The not so good news and the challenge is adapting to these new tax rules. The challenge is that what worked before does not necessarily work now. And what this meant is that we had to carefully re-examine everything that we were doing. Were we using the right tools? Were we using them in the right way? The federal budget came out last year, about this time last year, and for whatever reason, they used a YouTube video. So we're using YouTube also, though we may not get as many views as the federal government did. As we expected, the budget did not say anything about life insurance, and that made sense because the changes that took effect on January 1st of 2017 took years to develop and years to implement. KLU did a special report and confirmed that there was no impact on the taxation of life insurance policyholders. That meant we could get back to our work and we continued to re-examine life insurance products and the tax strategies. So we found that if you wanted to go from point A to point B, then sometimes the path was a little bit different or the method of transportation was different. As we got things figured out, we started doing public speaking. We spoke to various groups like chartered accountants, and we spoke to financial planners, investment advisors, lawyers, etc. A lot of these discussions were private, and so we don't have content that we can share regarding them. We also got interviewed in various publications and talked about how to take advantage of the new rules for life insurance. When companies introduced new products, we did quick overviews based on the marketing pitches that we got about how amazing the products were, and then we did our own detailed analyses afterwards to see how the products really worked. And when products were being changed in terms of prices, etc., we gave timely warnings so that there would be opportunities to lock in what was already there. Everything we did took more time, but that was okay. It's important to invest in your practice. And we were getting to the point of stability where we knew how things worked under the new regime, the products were getting stabilized, etc. And it looked like it was time for a vacation. But on July 18th, when everyone should have been relaxing, the government came out with a set of proposals which they said would improve fairness in the tax system, the way they defined fairness, which is not necessarily the way that Canadians define fairness. There is no mention of life insurance in these proposals, and that was not unexpected because life insurance was already changed so much as of January 2017. But clients were concerned about what was taking place. And the big issue was the taxation of corporate passive investment income. As we know, life insurance is a vehicle that is used to shelter investment income, especially in corporations. And there was no reason to think that life insurance would not operate the way that it did before, but there were concerns, and we belonged to and still belong to various organizations that stepped forward to let the government know that their proposals had consequences that Canadians were not willing to accept. We also engaged in our own campaigns. We had one to defend doctors. That was a group that was getting stigmatized by the changes. And we also had a letter writing campaign. What the organizations we belong to were saying is, since the government was not listening much, the best course of action was to talk to local MPs and then have them talk to the government on our behalf. Following that, there was a lot of waiting to see what the government would decide to do. Finally, last week, we got a new budget, and as expected, life insurance was spared once again. KLU did another special report, and they noted that there were no changes related to exempt life insurance policies, no changes to the capital dividend account, which is important in corporations, no changes to tax rates for individuals or corporations, and there was no change to capital gains either. There was concern that the portion of capital gains that gets taxed would increase from 50% to 67% or maybe even 75%. So all of this was good, and that meant it was time to get back to life. A reminder, what we're talking about here is simplified for clarity, and you can share your thoughts and comments using the chat box on your screen. We created lots of new content to help people understand how life insurance works, and this is one of the things that Jeevan put together to help people understand. So with insurance, what happens is you take a deposit and you put it into the insurance policy, and then charges come out. If you like, you can stop right here and you essentially have term life insurance because that's all it does. If you want to go further, then you can make additional deposits, and now you have growth in a tax sheltered fund. And what's great about this is that the growth is compounding in a tax sheltered vehicle. That's very good. Not all products do have this sheltered fund, and not everyone who has a sheltered fund uses it effectively. Now, the money inside the policy can be used in different ways. A classic solution, especially for business owners, is to supplement retirement income. What you do here is you take the cash-rich insurance policy and you assign it as collateral to a lender, and then you get tax-free retirement income by taking loans. Now, there is loan interest to be paid, but what's really good here is that the lenders will often say that you don't need to pay the interest on an ongoing basis. They know that the loan is secured by the cash value of an insurance company, sorry, of an insurance policy backed by a multi-billion-dollar insurance company. So that's pretty secure. So the loan interest can keep growing and growing within limits, and then the tax-free death benefit can repay the loan. So this is a pretty classic strategy. Something else that can be done is to use insurance as an investment strategy. So here you take the cash-rich insurance policy to the lender again, but instead of waiting years and years to take loans, say at retirement, you take loans right away and you invest in qualified investments. And here you generate taxable, traceable investment income. What happens in this strategy is that you do pay the loan interest on a regular basis. So that means that the loan interest is not growing. The loan interest is not growing and growing because it keeps getting repaid. So that's one thing that happens. And then also there is deductibility on the loan interest. As you can imagine, with a strategy like this, it is essential to get guidance from your accountant to make sure that things are being done properly. And for the investments, your investment advisor is really key. And you may also want help from your financial advisor to help make sure all these things are done properly. So you've got the tax deductibility on the loan interest. And in some cases, you can also get tax deductions on some or all of the insurance charges. So this is a pretty effective approach to using insurance for people who want to invest in the kinds of vehicles that are not available inside insurance policies. Finally, the tax-free death benefit repays the loan. Leveraging can create very large tax deductions. So because each year your collateral is growing in value, and if you borrow against that increase, then the deductions keep growing and growing. So it's really important to get advice from your accountant and other parties to make sure that the structure is suitable. So you can see that there are lots of different things that insurance can do, and we tend to talk about the different building blocks. The way the industry normally works is they put labels on everything. So they call things like immediate financing arrangements or corporate insured retirement plans, et cetera, which tends to simplify, but it also tends to distort. Because the reality is that there is a lot of complexity. Life insurance is at the intersection of 5 distinct worlds. There's the world of planning. So this is the place where the financial planner comes in to get the soft facts and also the hard facts. There's the world of risk, which is where actuaries step in to look at the probabilities of risks and the severity. Then there's a world of taxation. Where should the premiums come from? Where should they go? Are tax deductions required? If so, what is the size of deductions required? Are they needed corporately or personally? There's the world of investing that relates to investing inside the insurance policy, and in the case of leveraging, outside. And finally, there's the world of law, because you are buying a contract, and a contract has rights and obligations. To make this work, it's essential to have an independent team where the advisors are proactive, so they bring ideas when they're fresh, so as we are right now. They're collaborative, so they work with one another rather than in silos, and they're specialized in their own areas. So when it comes to corporate strategies these days, what can be done in the new environment is to improve protection, have tax-deductible business expenses that provide tax-free benefits for employees. One approach is to have a wage loss replacement plan, and we just went to a presentation on this earlier this week. Here, what you do is you have a combination of group long-term disability insurance, and you add to that personal disability insurance. And what's good about that is that the personal coverage is portable. So that means it can be taken with you. And because you're dealing with this kind of structure where you have two or more lives, the underwriting requirements are reduced, making this easier to get. Also, there's health, dental, and travel insurance. And this is also important. The options available depend on age and factors like pre-existing conditions. The thing to remember is that you can only qualify for insurance before you need it, and you never know when you're going to need it. Another strategy is for retirement income, where you can do it in a couple of different ways. You can use pre-tax corporate dollars to generate taxable personal income. The two ways of doing this, one is using a retirement compensation arrangement, or RCA, or an individual pension plan. Those are good ways of doing it. And another approach is to use insurance, where you take after-tax corporate dollars to create tax-free personal income. So you have a corporately owned life insurance policy, and in this environment, you may need to pay a guarantor fee because you're using a corporate asset for personal use. And this is, again, a place where you'd want guidance from your accountant to make sure this is right. And we have the capabilities to compare all three of these options for you. Just to let you know how the environment keeps changing, we got an invitation yesterday for a webinar that Manulife Bank is doing on the very topic of personal borrowing using corporate life insurance. The issue is that unless this is done properly, the entire loan could be deemed as income to the borrower. And so Manulife has taken some steps to help prevent this. And in their webinar, they'll be covering Bill C-29, the whole issue of how much clients understand about these strategies, and also the very important topic of what happens when the borrower dies. There's also the strategy to shelter passive investment income, which we looked at earlier. Here you get cash value life insurance, and there are a number of questions. Do you want the growth to take place early on, or do you want it to be later on? Risk tolerance, are you dealing with someone who is risk averse or seeking risk? And then the investment style, active or passive. So based on those things, we can come up with different kinds of solutions. It's important to note that not everything changed. So for example, critical illness insurance is the same as it used to be. Disability insurance has not changed either. Ditto for long-term care insurance, though there are fewer companies offering this product than there were a year ago or even a few months ago. Change is relentless, and it's important to keep track of what is taking place. Some of the things that we are watching are the effects of last year's ban on genetic testing. This can have an effect on prices. And also, there are rules around the capital that an insurance company needs to keep in place. The current rules were in effect since 1992, and there's a new regime that's taking effect this year. So the questions are, will this have an effect on prices, and will this have an effect on the guarantees inside products? So that's what we wanted to cover in the prepared portion of the presentation. Now it's time for the discussion where you can ask us questions. And so the way you can do this is that you've got a chat box on your screen. So please let us know what you would like us to answer. And Jeevan will just tell us what questions we've been receiving. Okay, so just tell us what the first question is, because we also got some questions that people submitted earlier on. So what are some of the questions that we've got?
So what are some of the main considerations when deciding if someone should leverage their cash value life insurance?
Okay, thanks for that question. The question is, What are the main considerations when deciding to leverage cash value life insurance? There are a number of them, and we've actually got a whole presentation on that topic. Key things, first of all, you need to have a need for insurance. When leveraging, because you are creating tax deductions, you need to have high enough income to use those deductions, not just today, but on an ongoing basis. And you do need guidance from your accountant to make sure that things are structured in a proper way. So there are a few things like that. And first, and of course, the person needs to be comfortable with the whole idea of leveraging, and not everyone is.
So if tax rules change again, will that affect any current insurance, or will those be grandfathered as well?
Okay, that's another great question. Thanks for asking that. So if the tax rules change, and luckily for insurance, they don't change very often, what would happen to the policies already sold? So generally speaking, with insurance, policies that have already been sold are grandfathered or grandmothered or grandparented under the old rules. And that's because of lobbying that is done on behalf of the consumers, the insurance buying public. So the expectation would be that the government would allow grandfathering, as they just did on for policies issued before 2017. Again, we can't guarantee this, but that is certainly what the industry does strive for. So last year, when there was all this concern about what was happening with the tax rules, one of the messages was to buy insurance before the tax rules changed, because that would be a way to likely grandfather the rules.
So we have one more. Can you explain the overall benefit of purchasing life insurance and taking a loan against the cash surrender value to then purchase investments versus not using the life insurance and just investing directly?
Okay, yeah, that's a great question. You could invest directly, so why go through all these extra steps of using life insurance? The reason is that if you need life insurance, then you can't get it by investing directly. Also, you've got very secure collateral inside life insurance, and by structuring things in a proper way, you are able to get tax deductions on the loan interest and also on the portion of the premium. So this can have the effect of reducing the cost of insurance well below what it would be normally if someone was not using this strategy. And also, when you're investing, you are able to invest in the same kinds of investments that you would have invested in before. So there isn't much of a loss in terms of what you can do, but there are some significant gains by going through these extra steps. Again, we're generalizing here. Each situation is unique and requires careful discussion to make sure the strategy does make sense for that particular person. Okay, and those are the questions that we have. So we'll just go to the wrap up. And if you have other questions, you can always contact us. But we do want to keep things on schedule for you because we know that you are busy. So closing thoughts, protection and tax strategies still matter. And that means that life insurance still matters because there are significant tax advantages available with the products. What's different now is that it's ever more important to make sure there's enough knowledge when using the strategies, to be creative based on the new environment, and in particular, to collaborate. It's very important that advisors not work in silos, but work together to come up with solutions that are integrated and work overall. And of course, since we are talking about insurance, while there are amazing tax advantages, it's essential to always start off with a need for the insurance itself. You can explore more by contacting us, by going to our website and chatting with us, and we'd be glad to help you further. So thank you very much for attending this live stream. This is our very first, and we are now done. So thanks again.